Good afternoon, everybody, and welcome to the Market Monitor for November 10th, 2021. This is John Hickey, Vice President of Investments here at Corporate Central. And I'm going to go over a couple of recent economic releases and labor market stuff and Fed outlook at the meeting today, and maybe capture some of the investment options that are available too in mortgages and callables, etc. But kind of give you a thumbnail sketch of the outlook in the medium term. Start by going over a couple economic releases. First, the labor market. We saw the U3, which is a traditional benchmark unemployment rate, dip to 4.8%, and the U6 fell to 8.5. The U6, again, to remind everybody, is the underemployed, the so-called MIT physicist working at Walmart as a greeter, an underemployed person who is working, who seeks full-time work. That's captured in the 8.5% metric. And the U6 was traditional unemployment numbers back below 5%. So it looks like we're almost back to, not quite back to pre-COVID pandemic style unemployment rate, but again, at least the rolling averages, 4 to 5% was kind of considered the bellwether full employment band going back many, many years. And we are there now, according to the U3 metric. And labor force participation rate. This is interesting too, because that dipped 10 basis points, meaning that a lower percentage of people are working than they did over the same period that U3 and U6 dropped so dramatically. So that's kind of the conundrum with this particular outlook this time around. And again, with the percentages of non-farm payroll and the baby boomers retiring and the ones who put it off from the 08-09 crisis, who lost most of their investment portfolios, have now fully recovered it. So now they're probably retiring it at a pace much, much faster. But this shows here, we are 5 million payrolls below where we were pre-pandemic. So it's certainly a good numbers. It's an aggregate numbers of people who are working today compared to working pre a COVID outbreak and pre-pandemic and pre and all the rest of it. So 5 million less people working, and anecdotally, we all see it out there in the restaurant business. A lot of short order cooks, a lot of fast food places are only open, limited hours, carry out only, etc. And they cite a lack of labor as the reason why that is. We had a print about a week ago of non-farm payrolls around 549,000. So 550, again, if we continue that clip every month, adding 550,000 payrolls per month, it's going to take us a couple of years to get back to the pre-COVID trend line. So again, the demographic shift that's occurring here. I saw a press conference from Janet Yellen today, again, the current Treasury Secretary, how she's not alarmed at all about inflation. And again, the lack of labor, which would mean you have to pay them more to entice them to come to work for you, etc. That's inflationary. The price of goods, and we'll get into that a little more detail later, but the gas prices, again, anecdotally are up, 30, 40, 50% in the last year. So the non-farm payroll employment clip may not actually sustain at 550, given the aggregate underpinnings of expenses that you're facing going forward. So, trucking, dock worker types, there's a major backlog of those workers right now. And all the incentives in the world aren't going to change the fact that there's just fewer qualified people in those roles when they were pre-pandemic. And you ask the question, where did everybody go? Those 5 million people that were working pre-pandemic aren't working now. And again, a 4.8% unemployment clip isn't terrible, but it begs the question, will this alleviate itself quickly or not? And that's kind of the territory between people who favor more intervention by the Fed and people who don't, what the answer is on getting those additional 5.5 million back in the labor force. This is the so-called JOLTS. Again, the general principle behind this chart is that employed people quit their job for a job making more money somewhere else, or a job with fewer hours at the same money, or something along those lines. So you see the gray bar, the thin gray bar at the start of the pandemic, the massive drop because they were getting laid off. They weren't quitting. And since then, and the recovery, people are leaving their jobs in droves. Again, chasing the higher benefits, the higher pay, the higher whatever, the better working conditions, et cetera, to find a new job. So that's the biggest risk, according to the employer survey now, is maintaining their current workforce, incenting them to stay. And they're doing that in the form of, more remote work, better, environment, because, again, the margins are pretty thin. A lot of jobs they can't afford really to pay a lot more just in money, but it's benefits and et cetera, childcare, those types of things that they're offering to get people back, because women are disproportionately affected by people not going back to work, again, because of childcare expenses and lack of a place to go. With some schools are still remote, at least nationally, California, New York, et cetera. Not everybody's back full time. And again, that's a lot of people live in those areas. So they drag the numbers more favorably down in those regards. This is a mean and a median unemployment duration. So again, the percent time that people are unemployed before they find work. And to kind of review Economics 101, there's 2 million unemployed. The median is the 1 millionth. So right in the middle. And again, the average is in the average of all, the average weeks unemployed divided by the number. You can see the median and the mean have diverted quite a bit here, meaning that, this is showing that there are legacy unemployed persons much, much longer that is dragging up the average relative to the median number. And this is not a good sign. You see, there has always been some historical spread between these two variables going back to the 70s, but how they're almost evenly correlated at the beginning of the pandemic and now widened out again. And the median is dropping quickly and the mean is dropping slowly. And again, that's just a sign of probably the federal matching dollars that were canceled, I think, at the end of September. So we may see a rebound in this. And I think the non-farm payroll number last print at 549 reflects that as well, because we were in the 250 range, 220 range in the previous prints before that. So this may well be, the people with the slack and a bit of a delay in the end of their financial incentives, even the federal incentives, that going away to them being compelled to go back to work. So we'll see as we approach Christmas if this improves, but we'd like to see that average number dive in closer to the median number to show that, the legacy expenses from long-term unemployment will be dropping in lockstep with that number deteriorating. So again, you've heard this a lot over the last several months, I'm sure. A lot on the Federal Reserve Board earlier in the spring and the summer had talked about they expect transitionary, the inflation metrics from the supply chain reopening, the bottlenecks that'll be present. Again, China has their own issues with coronavirus outbreaks and lockdowns domestically. But they think that just while the goods are coming back online, they claim Americans in particular are buying more goods than they did pre-pandemic to kind of like make up for lost time. And then they think that, again, the bottlenecks will be transitionary and it'll only be a temporary phenomenon on inflationary pressure. So you can see the survey here, May, June, July, August, September. It's eroding, but it's still very, very high, and an odds-on favorite that is transitionary, but the number is certainly eroding on the transitionary survey, going to the more permanent. So now 30% in the latest survey in October think it's permanent, but it's still 2-to-1 on surveyors, even with the data from October, who think that this is inflationary. Inflation is a transitionary a thing only. But again, this is more, I guess, rationale for the people who favor the transitionary side of things. Lumber prices. We all remember, the board feet of lumber tripled, quadrupled. A sheet of plywood at Home Depot was $60 and it was $15 a year ago. And all that anecdotal stuff you heard all summer long. Well, lumber is down to almost a pre-pandemic level now. So they say, well, see, this is evidence of a transitionary inflationary metric, and it's just one commodity, but it certainly gives the underpinnings of their rationale that it is an inflationary spike only. Another thing too, inflationary, you see the numbers are pointing down, but again, the egregious increases in shipping rates from China to New York and LA and Rotterdam in Europe. But this is really a scare, it's almost a scary inflationary precondition, given the fact that, a lot of products from China, are low dollar items on the shelves at your big box stores, your $6 trinket. It costs more to ship it than it does to manufacture it. So it's a double whammy when transportation expense is that high relative to the retail price of that good. So again, a lot of the small dollar items were going to be super, super inflationary. And again, the Christmas season and the rest of it, again, the real purchasing power will be eroded. In fact, because, lower income people shopping at big box retail stores are going to pay higher prices on everything, including low dollar items, under $20 items at the store. And it's directly correlated from the shipping expense from that particular thing. But you can see, the trend line is down, but still we are way, way off. It's still almost triple Shanghai to Los Angeles from it was pre-pandemic. And we all know Los Angeles, with some of the trucking restrictions there, they can get the goods off the ships at Long Beach and LA, but they can't get it picked up by semi trucks and hauled out. So they're stacking containers in the street and on the roads and outside the shipping yards. So it's a major bottleneck. It's not just the ships all sailing offshore 3 miles, 80 of them or 100 of them. It's inside the unloading ports too, where they just don't have trucks to get, because they change emission standards. They won't take any truck that was manufactured before 2011, I believe. So it's difficult to get your owner operators in there to help alleviate the strain because of the restrictions on trucks. So that's a big, big bottleneck. And again, inflationary risk going forward. The Consumer Price Index is printed this morning. This particular chart here is all urban areas, which captures 88% of the population in America. The blue line, again, was about a 6.2% year-over-year increase in prices. The red line is less food and energy. And again, back in the 60s or 70s, they stripped food and energy from the CPI number, in part, because of the OPEC embargo that spiked energy prices. A flood in Iowa that spiked commodities and corn. And again, you remember the movie, Trading Places, the orange futures market from a frost in Florida. I remember those vividly growing up, that those types of reports really move the market a lot, the crop reports and the damage from frost and all the rest of it. So because it's so volatile, they stripped those energy and food out of the metric. So even stripping energy and food out of the metric, we're still almost 5% year over year. And you remember from the Feds, they're targeting 2%, right? So, well, it's more than double 2%. So shouldn't that mean you're raising rates? Well, not necessarily, because they had, the language, it's got to average 2%. So this is 1 quarter, one print. So does it mean 3 quarters? Does it mean 4 quarters? What average term? Yet to be seen as we go forward. And this is the print from this morning. And what's alarming, just the baseline number being up so much, but the month-over-month number, it was 3 or 30 basis points came in higher than the estimates. And in the year-over-year number, it came in, 30 basis points over the estimates. And again, these aren't a bunch of flunkies making these estimates. These are people with real data, with PhDs and every computer in the world to crunch the numbers. And they had a big miss on their estimates. So this is really alarming on inflation pressure. And like I mentioned earlier, the real wages year over year are down almost 2% in October. So again, the wage inflation minus the purchasing price relative. So it's effectively a negative 1.6%. You're earning less money you did a year ago relative to what you could buy, the buying power of your income. A lot of it is blamed on used cars. You can see here the Manheim used car index, and you've heard people talk a lot about this with the chip shortage from the supply chain. Again, giving more fodder to the people who believe it's transitionary is causing this spike in used car prices because there is no supply of new cars. But again, it's certainly recovered quite a bit, but bounced back again. But it's usually a lag, like it says here, of about a quarter. So I'm looking till at least the early part of 2022 before the used car prices, come down to a more moderate increase. and more supply comes online with new auto manufacturing, for this to be alleviated, and this will elevate the CPI numbers. So, take it for what it's worth, but this does partially throw a favor to the transitionary side of the argument. But again, this is a major change year over year, and you're getting, what you paid for a car 3 or 4 years ago on trade, and that's something's got to give. And it's just a matter of the supply chain on new with chips and all the rest of it that's causing it. So we'll see going forward. The producer price index, again, this is also up 8.6% year over year. So again, the wholesale versus retail kind of argument. The producer price index is more of a wholesale number. So the people who make goods and aggregate, and they buy 700 tons of steel, and they make something, they sell it. So this is what they're talking about, year over year index number. And what they're pointing to, and it's almost laughable if it wasn't so serious, is that the actual came in under the forecast. So it's 10 basis points under. The red lines there is what actual came in versus the forecast. So they say, okay, well, it's better than we expected, so therefore it's transitionary. But that doesn't wash with me. That's a pretty big print year over year. And you see the 8.6 and 8.3 previous. So having a 30 basis point increase month over month from the previous print, which is already high, is a lot. And again, going back to July of 20, you can see the ridiculous increase in producer price indexes year over year. But again, like we talked about in the past, a bad print a year ago versus today, it's an egregious number because it's a bad number last year. But we're more than a year into this pandemic. It started in March of 20. So we're more than a year into it, and the year over year anomaly is kind of worked its way through the market now. So that doesn't really apply in my mind in many ways. So a quick of a Fed update too. The Fed had the last Fed meeting, which is its last week. They announced they plan to taper from the QE portfolio. And again, to remind everybody, the QE portfolio, the Federal Reserve agrees to buy, treasury bonds printed and mortgage-backed securities originated in the market as a way of signaling to the market, yes, rates are going to be low. We have, $140 billion a month, $120 billion a month, of securities, 80 in treasuries and 40 in mortgage backs. And it signals to the market that, this is where we're going to be. So it keeps rates down. But the pace they spoke about, they're going to trim their purchases by $15 billion a month. So you can see the gray line and the dotted on the right-hand side of your screen there, that is just growing slower. Because they've extended the portfolio so long, the runoff and the burn off of maturities and payments is slower than new additions. So they adopted the Washington speak from Congress, where slowing the growth is considered a cut. And we all know that it isn't. And all they're proposing is slowing the growth. So again, this perpetuates the other side of the argument that inflation is going to be out of control because we're not even controlling the size of the portfolio. We're just slowing the growth, which is not cutting. It's not the same thing. And they signaled in previous meetings that they will not do any raising of rates until they taper. Well, this last announcement wasn't truly a taper. It was just a slowdown of purchases. So we'll see where we go from here. But there's a lot of mixed speak here at the Fed, and the market's having a hard time just taking it all in and just accepting it at face value, given the underpinnings of the CPI print, the PPI print, the housing market, again, and the year-over-year changes in that, the lack of labor, increasing wages to attract qualified workers. It all spells inflation. This is their outlook from the median, the confidence intervals on, what, given the dot plot and each Fed governor's outlook, the trend line on the averages, or the median rather, on where they expect rates to be, and be back around 2% in 2024. So 3 years from now, with a gradual rate pace increase, 21 to 22, I think there's one built in next year in December, according to this particular rate hike model, one rate hike in December and then two in 2023. So again, the pace is much slower than the market expects, but this particular one is just a Fed funds futures graph. And the green, yellow, and red lines, December, this is what the outlook was at that point in time. So you can see the sentiment has shifted pretty dramatically and pretty obviously to anybody looking. And I printed this morning after the CPI print went live, is when I derived this data from. So it's looking at Fed funds at about 60 basis points. Right now, Fed funds is 8. So that's 2 hikes are built in a year from now, about a year from now, using the Fed funds futures market. So the market doesn't believe the Fed, that they're on hold, maybe 1 hike, and then we'll see what happens. The futures market is pricing in a lot more relative action on the Fed more quickly than what they're letting on. Other thing at the Federal Reserve Bank that is interesting, you may have followed some of this over the past couple of weeks or months, but some of the headlines in the market we've seen a lot lately. Jerome Powell, who is Fed chair, on his financial disclosure form, he sold $5 million of stock from his personal account. And, it occurred right before the crash, right? But reading more into it, he did disclose it, and he did this action months before he actually executed it. So, according to them, they did the financial disclosures in accordance with the rules and regulations at the agency. But still, this is a headline in the market, and it's not going away. The vice chair, Rich Clarida, also rotated millions of dollars out of bonds into stocks in February 2020. And again, it's right before the Fed cut rates. They had that intra-meeting emergency rate cut, and they cut again the following week. So going into stocks, it's like perfect timing. Again, I'm not accusing them of anything, any wrongdoing. They followed the rules that they set for themselves at the Fed on the financial disclosures. All these people follow the rules. Regional President Kaplan Rosengrens both resigned after this went public, that they sold a bunch of stocks and made all this money with large moves that happened right before the Fed met, and the public record didn't reflect it, and so they resigned. They quit. They're out. They don't want to take the scrutiny. And this week, Randall Quarles resigned at the Federal Reserve Board effective the end of December. So he was in charge of regulatory on the regulatory side of the Federal Reserve Bank. He's appointed by Trump 4 years ago. His term does expire anyway in early 2022, but he resigned now. So, we may have a major shift in Federal Reserve officers in the next, coming weeks. This is the current Fed Reserve Board voting members who vote on policy. And again, to give you a quick thumbnail sketch background on it, there are 12 Federal Reserve banks. And of the 12, the New York Fed is always a voting member on rate policy and forward guidance. The other 4 rotate. So one's always there. Of the other 11, 4 people rotate in annually. And then the rest of these are appointed, these chairs, these vice chairs, the head of the regulatory guy, Quarles. So this one here, Jerome Powell, is not supported by Liz Warren. And she is the head of the Finance Committee in the Senate, who has oversight on approving nominees for this chair. She said that, he's an inside trader. She called him dangerous to the market. And Lael Brainard, who is currently on the Federal Reserve Board, is more favored and supported by Liz Warren to chair. And it doesn't take, a hawk or a dove to understand the differences. I think anybody would measure it that Lael Brainard is much more dovish than Jerome Powell is on policy outlook for rates. Quarles just resigned, and this vacancy here has been vacant since Trump left office. So it's an unfilled candidacy. It's just a matter of nominating somebody and getting them approved by Senate that they're in. And again, this guy Clarida is under scrutiny. So this is a pretty major potential change in personnel who are voting on rate policy. And these 4 here are out too. Richmond, Atlanta, San Francisco, and Chicago, like I mentioned, 4 of the rotating chairs every year that roll out. And Rosengrens from Boston was set to go in, and he's one who resigned a couple weeks ago. So you could potentially have 8 or 9 new people on the voting policy policy chain at the FOMC. Now, again, they say it's consultative, and it's like, we all talk about it. It sounds a lot like groupthink, unfortunately, but certainly they move major policy changes through a consultative basis. But man, 2/3 turnover potentially, and probably likely by spring of 2022. that certainly poses, at least a question. At least in our own Constitution with the Senate, there's a third, a third, a third. Every 2 years is a Senate race, but only a third of the candidates are up, thereby to alleviate the risk of having too much turnover at any one time. This could be 2/3 turnover, and likely will be 2/3 turnover in early 2022. So we'll see if more doves take over. That's what the odds-on favorites are going forward. Again, doves think that we're going to keep doing QE. We're going to keep adding stimulus to the marketplace until labor market gets to wherever, inflation averages whatever. They might move the number. Those are all policy changes that they could adopt going forward. I didn't sit up last night and watch 10 seasons of the X-Files, but this is certainly something to keep your eye on as to who's going to chair these committees going forward and voting on policy initiatives in 2022. So this is a yield curve month over month. You can see the belly of the curve is up, 17 basis points on the 2-year, and on the 5-year it's down, but it's down on the long bond. And what's interesting is that the 20-year to 30-year is actually inverted by about 4 basis points. So again, what this might mean, I don't know if it does mean anything, but what it might mean is that the market is pricing in Fed action and then reaction. Like they're thinking the Fed might overreact, raising rates too fast, and then cut them again 4 or 5 years from now. So again, 20 to 30 years, people are buying the long bond, the 30-year, more than they're buying the 20, because they're betting on the Fed overreacting over a period of time. So that's one rationale for this might happening. And again, if the front end's up with the bear flattener, they call it, the front end's up and it flattens the curve with the front end moving up. Year over year numbers, again, look at the 30-year, only a 10 basis point change. With all the inflation and all the risk and the CPI prints and the PPI prints and the labor market, the 30-year only moved 9 basis points. So that's not much at all. It's very immaterial. So, that might point to, yes, a policy correction. They raise rates for 2 or 3 years and then cut again. So we'll see if that's right or not, but that's what a lot of the money is betting as we proceed through 2022. Here's 2-year Treasury yield, 3-year horizon. You see the big run up we've had recently from a lot of the inflation metrics and the print. So again, the Treasury will move up in advance of Fed funds, pricing in the so-called break evens, pricing in the pace of rate hikes. And the 10-year is pretty much range bound going back to, March of 2021. So for 9 months, 10 months, with all the inflation pressure and all the supply chain stuff and all the China and all the North Korea and all the Iran stuff politically, it's range bound in the same, trading between 160 and 140, all in there for the whole period of time, given all the volatility we've seen in the last several months and even the last year. So the long bond, the 10-year, the medium bond, doesn't really seem that affected by all the volatility we've seen. I would expect this to be much higher, actually. So I'm kind of surprised it's down really in the last couple of days. Investment options quickly. This is from the new callable prints. 5-year callables are at 127. 2-year lockout. But again, a lot of option risk there with a continuous call. So just take this for what it's worth, but you kind of benchmark this against mortgage backs. 15-year mortgage backs, power handle on a 1.5 coupon. What you need to be aware of, though, with these particular mortgage-backed bonds, if you're shown these by brokers, take a look down here at the bottom. This number, 3.6, 4.6, 6.6. So you'd expect them to run maybe in the plus 100 range, plus 200, because the coupon on these mortgages are probably, 220, 230, so very, very low rate. And they'll probably pay a little slow. But this is a spread over the interpolated Treasury. So you're only getting 6 basis points, 5 basis points over a like-term Treasury. And again, given the amortizing nature of mortgage backs, and you're going to have cash flows to 2036, your convexity profile is much more risky than it is with a bullet transaction that just rolls down the curve. Every year it rolls down by 1 year, 1 to 1. So I don't think you're getting paid enough on spread on the short mortgages. Now, the long mortgages, again, a lot more risk here, 7-8 year average life, but look at the spread over Treasuries, 50, 44, 45, 47. So that's a lot better. I'm not saying go out and buy a bunch of 30-year paper, because that's an awful lot of risk for an awful long time. But relative to Treasuries, That's a much better risk return profile relative to the 15-year benchmark, just in my opinion. But again, something you have to do with your own committee internally and risk committee. But I would say print 30-year mortgages on your own and hold them on balance sheet perhaps instead of doing this. But again, think of what it's worth. This is just new production mortgage-backed security color, and it was printed today. So this is a live offer of what could be offered today on a mortgage-backed security. That's all I have for today's call. I'm going to look and see if there's any questions in the Q&A. No questions in the Q&A. So I guess that is a wrap. It is 1/2 hour on the button. Enjoy your week. We're off tomorrow for Veterans Day, so please enjoy the holiday, and we will see you next time.